A very happy day to all of you and welcome to my YouTube channel. I'm your learning partner Sushila Hariharan. In this module, we're going to take a detailed look as to the term that was used extensively through most of 2021, and that is the Fed taper. We'll take a look at what is the meaning of Fed taper, what does it imply, and how does it affect markets and asset prices across the world. The Federal Reserve is a central bank and the monetary authority of the United States of America. They set the interest rates for the United States through their monetary policy committee called as the FOMC, that's the Fed Open Market Committee. FOMC decides and announces the monetary policy for the United States. These actions of the Federal Reserve are looked at very closely by global investors, by banks, by high net worth individuals, as well as hedge funds and mutual funds across the world because their actions impact the asset prices across the world. They impact currencies, it impacts interest rates, it impacts inflation, and therefore, whatever the Fed does and announces is looked at very cautiously and carefully by the investing community. Let's take the first scenario. In the first scenario, Fed buys Treasury securities via open market operations. What do we mean by buying Treasury securities? Treasury securities are securities issued by the US federal government. If the Fed buys these Treasury securities, it implies that liquidity is infused into the money market because the Fed is buying securities. As they buy, they return capital into the market. This liquidity infusion into the money markets. There's now an overflow of capital, of money floating around in the money markets that causes interest rates to decline. Okay? So this happened in 2008 when banks were struggling with the global financial crisis, and there was a concerted effort made by central banks across the world to control the liquidity crisis that existed at that point of time. So, what did the Fed do? The Fed decided to keep buying Treasury securities. When they kept buying Treasury securities, there was a surge of liquidity into the money markets, interest rates collapsed. This caused the markets to rebound and to go up again. This happened also during March 2020 and, in fact, almost all of 2020 because economic lockdowns caused by the coronavirus pandemic had created a very negative operating environment and financial scenario for corporates and businesses. The Fed kept buying Treasury securities throughout 2020. In fact, at the end of 2020, December 2020, the Federal Reserve had a balance sheet that was even bigger than the US government balance sheet. That's how much they bought securities and pumped the money market with liquidity. This is called as quantitative easing. So, two times when the central bank, when the Federal Reserve has infused liquidity by a very controlled purchase of Treasury securities was in 2008 and now during 2020 pandemic crisis. So this term quantitative easing refers to a release of capital, release of liquidity into the markets. The second one is the Fed sells Treasury securities in the open markets. What happens when the Fed sells Treasury securities? When the Federal Reserve sells Treasury securities, it absorbs excess liquidity. When it absorbs excess liquidity, it takes away the excess liquidity from the money markets. This causes interest rates to increase. This, in fact, is a tool that central banks across the world use when they have to attack inflation. When inflation starts increasing, creating a high price rise for almost all assets and commodities, the central banks adopt this strategy to attack and to control inflation before it becomes runaway inflation. So most often central banks across the world start selling treasury securities into the market, take away the excess liquidity, and interest rates start increasing. This means that quantitative easing has reversed. This is the technical term for the meaning of Federal Reserve selling securities. Now, the Federal Reserve is doing the third situation, and that is Fed taper. The Federal Reserve decides to adopt a more static approach towards tackling inflation because we are not yet out of the pandemic. Businesses are still suffering because of the lockdowns, but yet asset prices have increased. So, this has caused a very peculiar problem for central banks across the world, where asset prices have increased, inflation is soaring, and they are not able to tackle it by increasing their interest rates. What do they do then? The Fed stops buying treasury securities via open market operations. There is no more liquidity infusion in the markets. The central bank decides, let the market decide. Let the market participants play. Let them decide the demand and supply. And therefore, the interest rates will stabilize. So rather than going for a direct increase or hike in interest rates, a Fed taper or a tapering of their quantitative easing activities results into a more moderate approach for stabilizing interest rates. The interest rates stabilize, thus controlling inflation from running away, and that causes prices to be under the control of economics rather than just being recklessly increasing. Therefore, remember this, quantitative easing means dovish. So, when the Federal Reserve announces its monetary policy, analysts view the monetary policy as either being hawkish or dovish. Dovish means it's going to be more kind, it's going to be more benign, it's going to be softer. That is called as quantitative easing. That means interest rates are likely to be on the lower side. Hawkish means quantitative easing has stopped. That means central banks do not like inflation to increase beyond their control. They want to control asset price increases, and the best way to attack inflation is through the monetary policy tools of interest rates or open market operations. So, in hawkish, they are not looking positively at interest rates, and it appears that interest rates will increase. That is the meaning of hawkish and dovish, and looking in the context of Fed taper as well. If you have any queries, please post in the comment box. Thank you. Your feedback is important to me and my team. Keep subscribing to our channel so that you get updates and notifications on latest news on banking. Thank you once again.